good evening, everybody. Thanks for sticking out till the end. I think our presentation is going to be relatively brief. So I'm Stephen Williams, Sachin. We're co-chief execs of Reabold Resources. I'll give a quick summary overview of the business, where we are, what we do, and then I'll hand over to Sachin, who'll talk through the current asset base. So Reabold Resources, we're a natural gas and LNG development company, predominantly based in Europe. I think we're the only energy company this evening, so I think it's important for us to touch a little bit on the macro situation in the energy space as it stands today. I don't think it's a secret Europe is in the midst of an acute energy crisis. There's a woeful inadequacy of domestic supply and new supply in particular in Western European countries. We're heavily reliant on imports, often from unstable countries. Security of supply is extremely low. Pricing is extremely volatile. So it's our job at Reabold to go and look for already discovered but overlooked and undeveloped natural gas resource in Western Europe, take it through the development stage into production, and help to alleviate this shortage of supply issue. Now, of course, we often get the view, well, you're an oil and gas producer, we're in the energy transition, hydrocarbons are dead, who the heck cares, this is all going to be over in the near future anyway. Well, and we've heard a lot about the energy transition from some of the other companies tonight. Now, we certainly are not unbelievers in the energy transition, and I think no matter how fast you think the energy transition is going to take place, no matter which model you look at, every single molecule of gas that will be produced from our asset base in Europe will be needed and will be consumed in Europe on that journey towards net zero. Okay, so it's something for the future, but for the foreseeable future, there is a huge demand and a huge need for the resource that we are looking to develop and bring into production. Now, part of the reason why we have this issue in Western Europe in particular, has been the political mood and sort of regulatory action has been actively pushing back against domestic hydrocarbon production in favor of imports. But crucially, we're starting to see the first signs, and this does vary a little bit country to country, but we're starting to see the first tangible signs of governments and regulatory bodies in Europe recognizing this issue and actually starting to shift gear a little bit and starting to encourage and support domestic energy production, particularly natural gas, in recognition of these issues and recognition of the security of supply problem that we've got. And of course, at Reabold, we don't just do this for the good of society. We think we're putting investors into projects, into a commodity where the supply-demand balance is going to be extremely favorable, and therefore commodity pricing for natural gas in Europe is likely to be very robust for the foreseeable future. Now, the actual projects we're looking for, what are we looking for? As I mentioned, they're typically already discovered resource. We kind of skip the exploration phase. We don't think we need to play in that space. We're looking for things in the appraisal and development phase of their life cycle, which have been overlooked for various reasons by the industry. And we'll come on to some examples of that in a minute. Geology is kind of the key. So we spend most of our time when we're screening projects looking at the rocks and getting to understand the rocks themselves. We have to have rocks that will deliver commercial quantities of natural gas in order to make a viable project. And that kind of comes on to the sort of economics point. Okay, so good quality rocks tend to lead to low cost of supply, which is obviously what we're all after. That's how we make a decent amount of profitability. But the other thing that's key at the moment is we are operating in an industry which is devoid of capital. There is just not enough capital to bring oil and gas projects to market for various reasons. It's a sector completely out of favor and lacking in capital. So we're also looking for projects that we think there is feasibility of financing. So there's the only point of getting involved in a project is if you believe that it will be financeable all the way through development and production, either by us or by somebody else who takes the project off us at a later date. And it's therefore possibly not a surprise that our current portfolio is biased towards onshore projects, where total capital requirements are generally significantly lower than in the offshore. And in fact, between our West Newton project, which is up in Yorkshire, and our Colla Santo project, which is in Italy, we believe we've got the two projects that we think are the two largest onshore gas developments in Western Europe, which is not bad going for a company of our size. And the final point on here relates to exit. It's also very important when we get involved in a project that we think about potential exit. Now, it may be that certain projects we stay in all the way through the life cycle and take into production, but particularly if we think that development capital is going to be an issue, we have to make sure there's a way that we can move the project onto somebody else who will themselves possibly take it into development, and we will take capital out of that project and look to a combination of returns to shareholders and recycling into other projects. So that leads nicely on to the next slide, which is in relation to a project where we've already done this. So the Victory project, which we held via a company that we're invested in called Corallian, is really the proof of this model in action. Okay, so we get asked a lot, well, if these projects are so good, if the geology is so good and they're going to be very profitable, how do you find them? Where have they come from? It's inconceivable that they've been left behind. Well, it really isn't. So the Victory project was discovered, or the Victory gas field was discovered decades ago. It was held by a number of larger oil companies who never bothered to take it through to development for various reasons. We picked it up a few years ago via our investment in Corallian. We funded it through the early part of the development cycle, and then we sold it to Shell for a significant uplift in value. I think it's one of the only North Sea assets that's been purchased by a major for many years, which I think is proof of the quality of the project and proof of the business model in action. And coming back to the importance of exit, this project was located offshore, and in fact in a very difficult area offshore in the west of Shetland, an area where we simply would not have had either the capital or the capability to put this thing into production. So clearly the most sensible thing for us to do from a business perspective was to exit, was to take cash from Shell and to use that for a combination of distribution to investors and to recycle into other projects. The majority of the cash that we're expecting from this transaction is yet to come into the business. It comes at the final investment decision from the field. That's what that triggers the final payment. So we're expecting over £9 million to come in from this sale in the near future when we get to the point of FID. So that's the business model in action. We're going to replicate that with our current portfolio of assets, but on a larger scale. And hopefully we'll be able to replicate that with other projects that we hope to bring into the portfolio in the future as well. So with that, I'll hand over to Sachin to talk through the current asset base.
All right, thanks very much, Steve. So what we'd like to reflect as we go through the project portfolio is really to bring out the points that Steve made. One of those, in part, is how is it that we've managed to get our hands on strategic onshore gas projects in Western Europe, and how are we able to identify and move them forward? And each one is a case study in its own right, and essentially, as I go through it, that's some of the themes that that we will be bringing out. Whoops. Wait. Okay, so recently, Reabold made an investment into LN Energy, whose key asset is the Colasanto gas field onshore Italy in the Abruzzo region. So this is a gas field that has had 8 wells drilled on it. 2 of those wells were tested as well and flow tested very well. These 2 wells remain suspended, and as we conceive the development plan right now, will be the 2 wells that will be the producers for an micro LNG project. And why the micro LNG project? 2 reasons. The first one I'll discuss now, which is recognizing that natural gas is not only an important fuel for now, but also has a role to play in the transition. And Italy has specifically identified LNG as a transition fuel for road transportation in the form of LNG. So that natural gas and that development plan is envisaged to be in that way to, as I say, target the importance of security of supply, not only now, but also in the medium term. Right, I will now move on to sort of discuss how a field that's had 8 wells drilled on it with 2 producers that has been completely de-risked from a subsurface point of view by these wells was picked up by a small company like us. Well, it's a significant asset, one of the largest undeveloped gas resources in Western Europe. And really the reason around this is the second element of why we chose the micro LNG project. And that was to do with regulatory approvals in Italy. We originally looked at this project 6 years ago, and there were various project owners with development plans that were, I guess the best way to describe it, intrusive of the regional area. And because they were intrusive, it met with a significant amount of resistance. And the micro LNG plan has a much smaller footprint and much less intrusive to the region. And when we think about the regulatory framework in Italy, it really falls at two levels. One is at the national level, and the second is at the regional level. So I've already discussed why at national level the micro LNG project was important. Steve mentioned the security supply issue and the actual LNG approach to that. And then at the regional level, we actually managed to get into a place where we were able to bring the local community and representatives along with us, such that we announced last week that the region will be providing approval for a test phase of Colasanto that we think significantly de-risks the ability to get this project into the long-term development phase. Specifically, on this well testing period, we will start an early production program, and the early production program will be gas to power, generating electricity, where the infrastructure to do so is all nearby and completely available for us to execute. So we take this project through, again, as Stephen was describing, a lower phase capital intensity as part of the early production program, whilst we arrange, organize, and resolve the issues for capital funding once we get the approvals for the full field development concession, that is micro LNG. So I do hope that that kind of gives you an example of one of the key projects, one of the strategic projects for us, how we were able to get involved in it, that we do look at these projects over extended periods of time and identify when is the right time for us to make the investment. Right, so I talked about what I describe as one of the largest onshore European undeveloped gas fields, because we believe we have in our portfolio the largest undeveloped onshore Western European gas field, which is called West Newton. And this is onshore. I'm not sure if you can see that very clearly, but it's located here just north of the Humber Estuary in the Hull area of northeast England. And Pedal 183, as I said, houses the field called West Newton. And West Newton has had 3 wells drilled on it. And these have essentially de-risked the resource size. In addition to de-risking the resource size, a significant amount of work that has been undertaken as part of our involvement in West Newton has been identifying the optimized way to drill a horizontal well that will ultimately be one of the producer wells in an 8-well development program for the West Newton field. So we believe it is significantly down the pathway of de-risking from a subsurface point of view, where the next well to be drilled, called West Newton B2, will ultimately be the well that I think really unlocks this field. A couple of things just to say about this area and why we were able to pick this project up. The industry in the UK is dominated by the North Sea. And for reasons that are sometimes difficult to explain, the North Sea is deemed to have the North Sea and its geology, and onshore UK, its geology, and never the two shall meet. And, you know, as we all know, it doesn't quite work that way. And we happen to have what we believe is essentially the easternmost end of the trend that West Newton sits on, which is a play fairway called the Zechstein play trend here in the UK. It's been heavily exploited elsewhere in continental Europe, but in the UK, it's really an emerging play and an emerging trend. So that's one of the reasons that we were able to identify and pick this project up. One of the other extremely appealing aspects about this asset, and again, thinking about this role of security of supply, is where it fits within sort of the strategic importance from a UK perspective. And here in Hull, or near Hull and in and around the region, the net zero carbon Humber project area has been identified to essentially take natural gas, create hydrogen, and sequester CO2 into the North Sea. So as part of playing into that trend and theme of net zero, West Newton is kind of ideally located for an onshore field. And really, we couldn't have wished for a better location, and that just happens to be a happy coincidence and circumstance. Now, as I mentioned, the next well to be drilled is the West Newton B2 well, and we have our exposure to the project in two ways. We have a direct license interest, and we have a significant ownership in the operator called Rathlin Energy. And Rathlin is currently seeking funding for its share of the West Newton well, the B2 well. However, there is a backstop potentially here, and when Reabold gets the funding or gets the monies from the Shell transaction, we could be a significant portion of the funding that is required for Rathlin. So we really don't see any issue about the well getting drilled. The real issue is about, I guess, the timing of when that well gets drilled. But these two projects, I think, form a really core part of not only the strategic value, but the near-term activity involved in the Reabold portfolio. I'll run through the rest of the portfolio, but these are, I guess, less significant both from the strategy point of view and from near-term timing point of view. So we have a set of UK license areas and interests in the central and northern North Sea, and these are much more in the earlier stage of the life cycle. We also have in the portfolio a project area called, through our holding in Danube in Romania, called the Parta exploration permit in the Ichia Mare production license area. That is currently on hold, and as we ration capital associated with moving things forward. And again, it's a slightly earlier stage than some of the other onshore projects that we have. And we also have an interest in Daybreak Oil and Gas, which is a publicly listed company out in the US. And that came about because of a merger of assets that we had in California that were producing, that we got from a standing start, that we essentially created a liquidity event by merging that with Daybreak Oil and Gas. And so essentially we are a shareholder in those operations. Right, so hopefully what we've spoken through and talked through here is the Reabold strategy and the importance that it has in providing the energy security and supply, in meeting the energy security supply issues from a natural gas point of view in Western Europe, which we believe has been neglected and has resulted in the significant issues facing us not only now, but for several years to come. To recognize the importance of getting these projects in a way such that we can extract value for them with very limited dilution, if any, to our shareholders, and ultimately fulfilling that whole virtuous circle of recycling capital into further projects and distributing them to shareholders, which meets the dual objectives of very good returns for shareholders as well as the strategic needs of Western European energy. Thank you very much. I see that's 3 minutes, so hopefully...
Thank you very much. Thank you very much. Thank you. Any questions at all for the chaps from Reabold? This gentleman here? Oh, sorry, sir.
Thank you.
Yeah.
Just a political question, really. What do you think the effect on Reabold will be if Starmer and Miliband take control at some point next year?
Yeah, shall I have a first
go
stab?
ahead.
I mean, look, it's obviously very hard to say at this stage. I think what was clear is that after a period of time when we saw almost entirely negative comments from politicians in relation to the UK oil and gas industry, when Starmer came out and basically threatened to shut the whole thing down, we finally had a backlash against it. And in fact, that's possibly the most helpful thing that anybody has said to the industry, because it actually mobilized the other side of the argument for the first time. And clearly that caused him to row back pretty quickly. So I think there will be a more pragmatic approach from an incoming Labour government than perhaps the rhetoric is suggesting at the moment. But we're always going to face, a degree of political uncertainty and a degree of, I guess, battle against certain political figures when it comes to this industry. But the other thing I would say, we obviously had a couple of years ago this huge issue of Russian gas suddenly disappearing. We were, to some extent, as a continent, bailed out by a relatively mild winter last year. We saw gas prices go through the roof on a wholesale basis. People sort of didn't notice once the government came in and subsidised it all. So it became, once the price went down, public attention started to disappear from that issue. It'd be interesting to see what happens if we have a cold winter and people try and turn their heating on and it doesn't turn on. Now, we obviously don't know if that's going to happen or not. It's very, it's weather dependent on other factors, but it's not impossible. And I think that will really refocus political opinion on the importance of security of supply. Sach, anything to add?
There's just one other thing I'd add on what Steve said, that when the pushback came on Sir Keir Starmer's statement, it actually came in many cases from union leadership in regions where there are a lot of oil and gas related jobs. And I think that just goes to show you how disconnected the original policy thinking was from the grassroots supporters of those policymakers, because the mindset is if it's oil and gas, it's bad. Right? And I think should not be understated in terms of the nature of the pushback.
Okay.
In common with other presentations this evening, there's a huge amount of information there that was very interesting. Your audience is primarily of investors, and I didn't hear from you, and I may have missed it, a comment on the return that you've delivered over, let's say, the last 5 years for investors, and what that should cause investors to consider the possible returns in the future, and how an extrapolation of your current figures might be erroneous and why.
Go first.
Yeah, sure. Thanks. So the share price performance of Reabold has been weak, along with so many other small oil and gas companies, in part for some of the reasons that we'd mentioned. Now, on that slide, I think what is key to highlight, which we spent a bit of time on, but we can talk about a bit more now in answer to your question, is the recycling of capital through distribution to shareholders. Now, there's the proposed £4 million return once the full Shell money comes in. Within context where our share price is today, that would be just under half our market cap. So the way and we accelerated some of that distribution by way of a share buyback. For various reasons, that has been on hold, including the fact that we're in a closed period currently. So we recognize as much as anyone that the share price has been weak, but one of the mechanisms that we can see correcting that is the business model itself via the distribution, in this case through a potential share buyback program of that significance. The mechanism of the distribution is something that we consult with our shareholders about, and we do that regularly. And I don't think it should be lost that it's not just the proposed £4 million distribution, it's what we believe we're going to be able to replicate from the rest of the portfolio. So I guess what I'm saying to you is, I guess we believe that the share price will be in a very, very, very different place in the future from where it is right now.
If you're discussing with shareholders, do you have large institutional shareholders? I'm not quite clear about the mechanism by which you would be engaging with your smaller shareholders.
Yeah, so we do have large shareholders on the register. I have Chris in the audience who can correct me if I'm wrong. So it's Premier Miton, that's over 9.5%, Ruffer, that's over 7%, Shelverton, that's approximately 5%, And then there are a couple of other institutions which are in that sort of 2 to 3% range. And then we have the directors themselves at about 3%. And so that does constitute quite a significant block of long-term loyal shareholders, particularly the institutional ones, that we will have that dialogue with. The retail one, we will find ways of having that engagement. One of them would be conversations like this. Our PR firm is here, and feedback can always be provided to them as well, in addition to roundtables and other conversations that we have with retail investors and or wealth managers and the slightly smaller shareholders in Reabold. So I don't know if that answers the question about the mechanisms that we try for engagement to ensure that we have a full and generally wide understanding of what shareholders want in terms of distribution.
Thank you.
Okay, thank you. Any more questions at all from the audience? Gentleman there, please, Peter.
Just a quick one. You mentioned UK energy security, but the government, or it's been quoted that actually companies like yourselves have to sell it on the open market, and you'll sell it to the companies or the organisations that give you the best price. That doesn't seem to ensure the best energy security for the UK. And surely it's a question of, unless the UK government nationalises companies like yours and say, we're mandating this price and it only goes to the UK, it's a red herring. That you're generating this profit, which is great for shareholders. In terms of the long-term UK security policy, it's got nothing to do with it.
So that's not quite true when you look at natural gas. So if we put the West Newton field into production, that natural gas will be consumed in the UK. That's not going to go anywhere else. So that is a source of supply that currently doesn't exist, that will exist. So the UK import requirement shrinks and the domestic supply goes up. There's a point, I think, in relation to what you're saying, which is more around price, which is that there is a price which is set by that international market, and that is relevant to the price for sure. But in terms of actual security of supply, locally produced gas will be consumed locally.
Yeah, but consumers have to be able to afford it. So if the price is so high that the people can't switch their ovens on, it's so expensive, we don't actually have real security.
Yeah, look, I mean, that's an interesting point, and I guess the government can take whatever action it thinks is appropriate to make things more affordable. You could nationalise, you could fix a price for domestically sold gas, but then you would kill the import market, so we'd run out of gas. Or you could tax everybody to oblivion and then recycle the taxes into fuel subsidies for people. I mean, these are the mechanisms that are used. But I think that fundamentally, just getting away from the price point, there is a more fundamental point, which is physically, there are not enough gas molecules in the UK to satisfy the demand for gas. They have to be brought in somewhere else. And if we can produce it here, that clearly adds to security of supply. I think there's anything to...
Yeah, so just rough breakdown. Someone can, I'm sure, check the stats, but 50% of gas production, the UK produces 50% of its gas needs. The other 50% gets imported. You only have to go back sort of 15 years where the UK met almost all of its own gas needs locally. And the pricing systems and the pricing volatility in particular that you see were very, very different. Nobody's arguing that there's going to be a general decline in the overall consumption of gas and production. What's the issue here has been the big difference between the amount we consume and the amount we produce. So everything that you've said, in theory, sounds good, but it's what's caused us the problem in the first place. I mean, that's why we have this problem.